Welcome to Contractor Cuts, where we cover the good, the bad, and the ugly of growing a successful contracting company.
Welcome to Contractor Cuts. My name's Clark Turner.
I'm Jared Flo.
Thanks for joining us again.
I'm back.
He's back. We missed you last week.
Yeah.
So today we are discussing borrowing money, lines of credit, how and when and why, and all of the things that we did wrong when we were doing it.
Yep.
We're still paying some lines of credit down that were borrowed years and years ago. And so
There's a large dollar amount straight off our bottom line profit.
Yep. We're getting close to the end, but we have some buyer beware stuff that we didn't know going into it that we'd love to share with our contractors, because there is a lot of danger in it, and there is stuff that almost closed the doors for us that we had no clue about until afterwards. So
and also some recommendations of kind of how, if you do it, how to keep yourself safe.
Yep, and I think one of the starting points for us is you don't want to borrow money.
Right.
You never want to, and I don't think anyone's like giddy and happy about borrowing money.
Do your best to fund from within.
Fund within, even if it means growing slower. But I think with entrepreneurs, guys that start companies, people that are growing contracting companies, we always have this rose-colored glasses of, but if I get that money, then I can get these jobs and I will make this much money.
Right.
And we never factor in the stuff that goes wrong. We never factor in your kid getting sick, and so I got to pull off these jobs and money's coming due. Or we never factor in, well, that crew screwed me, and so I'm out that money, and now I've got to hire another crew, and now the client's upset and wants discount, and we don't factor that stuff.
Right.
We don't. Those are all the unexpected stuff that we never expect.
But they're going to happen.
They are going to happen.
Yeah.
They happen in every company. And the whole point of what ProServe Alliance coaches on is we're trying to minimize the risk that's going to happen 1 in 10 times.
Yeah.
Don't let it happen 6 in 10 times, right? And so when you borrow money, you are really, really cutting short your ability to dodge those bullets, to say, okay, shoot, we lost, but I'm back to zero.
Yeah.
Right? You borrow money and you have those issues go wrong, you're in the negative, and now the bank's knocking on your door and you don't have a company anymore. Well,
and one of the other things, a byproduct of bringing a bank in and getting a loan, is you're technically bringing in a third party decision maker to sit at your table that doesn't have a vested interest in your success.
Yep.
They just care about their money and getting their money back.
Yep.
And so there's a variable there that's like, okay, maybe I should stay away from that. But sometimes there are opportunities that you don't have the cash to fund, that if I want to take it, I don't have the capital to take on this business, but it looks like a great opportunity for me. So maybe I look at, okay, let me get some funding from the bank to be able to take this on, to move into this new venture that if it works successfully, I'll be able to pay back the loan and move forward and be making a lot of extra money.
And what the second part of what you need to think when you're thinking that, not just if it works successfully, it'll be good. If it doesn't work successfully, what happens?
Right.
And if I've got a game plan for that, then I'm mitigating my risk at that point.
That's right.
So diving into our experience and the different types of loans, first we should say we are not bankers. We are not accountants. We are not giving you advice. We are solely covering our understanding and our experience with borrowing money as a contracting company.
That was a good CYA statement.
Yes, do not blame us when you go do something and didn't know, right? So,
well, what happened to us? Like, what was how to talk about that piece of it?
The things that we did right. We'll start there. We went very early on in our company. We had a bank account. My first bank account when we started the company was Wells Fargo. It was actually Wachovia back then.
Oh wow, you're old.
And we were with them and tried to get a line of credit because we had jobs. We had some not commercial clients, but clients that buy large packages of properties and they get 100 properties at a time. Yeah. And so they said, hey, if you can take on 30 houses, we'll drop 30 houses.
Well, and where that factored in, where it made it, we have to make this decision, is they had 30, 45-day terms on their money. We finished the job. It's 30, 45 days that I've got to float that money before I can start a new one.
So if I didn't borrow money, I'd do their jobs, and I'd have to sit on my hands for 45 days till they paid me back so I can do the next job. So that was the very beginning. I went to Wells Fargo and said, hey, can I get a loan? And they approved me for a very, very, very tiny loan.
Because they said, who are you?
Yes, because I didn't have millions in the account. And so what we did, one of the best things I ever did was I actually took my business to a very small bank that is now kind of formed into a larger bank, but I still have the direct cell phone of the vice president of that bank. Right. And so going in, even as a small company, I would strongly suggest get a local bank and get a relationship with a banker
100%
at the bank. That was the first thing that I think was the best, because their line of credit that they offered me was literally to the dollar 10 times the size of what Wells Fargo offered us. Literally 10 times, 10x of what Wells Fargo offered us, because they looked at our books, they talked to me, they looked at my finances, they looked at my credit score, they looked at everything as a whole, because for them, I was a potential good long-term client for them. So that's the first thing I did right.
And there was a built relationship with a person. It wasn't a 1-800 number. And if there were times we could call them up and say, hey man, here's the situation, here's what's going on. Give me your scenario of what will help. How can you help fix this? Can you work with me on this? And because they were a smaller bank, they had a little bit more discretion to do that type of thing.
And I mean, they have a ton of money as a bank, but a $300,000 line of credit to them means a lot more than $300,000 to Wells Fargo.
That's right.
Again, I'm not bashing Wells Fargo. No. I'm just saying flexibility as a small business.
That's what worked really well for us.
It would take 45 minutes on the phone with Wells Fargo to talk to a decision maker who would then have to email me in 3 weeks once something's been figured out. So that's one of the pros and the things we did right was getting that relationship going, borrowing money from a small local bank, credit union, whatever you've got around you.
And I think one of the other ones that we did right as we were processing through it is choosing to say, I don't want the ability to go over what my accounts receivable is.
Correct.
And creating that line for ourselves.
That was our check.
That was our check of like, okay, we've taken out too much in this line of credit because we're going over what's owed to us. And if we went under, we got to pay that back somewhere from something.
We tried to keep it, and we still advise guys that, to this day this way. Our line of credit was bigger than our accounts receivable. And accounts receivable meaning money that we've completed jobs on and people owe us that money. Right. So our accounts receivable, the money owed to us, we said we never want to borrow more than that. So if that was kind of our catch. If worst case scenario something happens, we could close the company, we can collect on our money and pay our debts, and we're back to zero.
Right.
So that was one of our rules that we tried to abide by. And that was what we also advise all of our contractors right now. That has to be in place if you're borrowing money.
It's just you put yourself in such a high liability place.
And we actually had a line of credit bigger than our accounts receivable, but we were pretty good at staying underneath it at all times. So I think those are some of the good things we put in place with it. I would say in hindsight, a couple things that we did wrong. First off, if I was doing it over again, I would probably look for a different type of loan than a line of credit. Pros and cons of there's thousands of different types of loans. Small Business Associate, SBA has really good terms on loans. Especially since the pandemic, SBA's got like 30-year term payback.
And it's a standard traditional loan.
But again, going back to the small bank versus large bank, SBA doesn't care your situation, right? We went through the pandemic. We literally lost in 1 week in the pandemic, because half of our company serviced those big clients. We literally lost, I think it was like $250,000 a month in revenue overnight. That first week of the pandemic, when everything shut down, we lost $250,000 a month. So that's almost it's $2.5 million a year in revenue that just disappeared. And so when that happened, we were able to call our bank and say, hey, this is what's going on. I can't pay my terms on the loan. And if you need to do something, like, we got to work something out. Right. And it was, I had the person to call, and for him, it made the most sense to work on terms and give us a couple months grace because then they'll get their money back.
Yeah.
They know that it's a low chance of getting their money back. But if I'm borrowing from the SBA, there's no one to ask for help.
Yeah.
It's, well, you owe us the money.
Yeah.
And
Well,
so,
and if it's a $100,000 loan, a $500,000 loan to the SBA, that's tiddlywinks. So they're like, just foreclose on those people.
yeah,
We don't care.
my job's collecting on this, and if it's not being paid, then it's getting collected on.
Right.
So again, what I would have done though in hindsight is I would probably look at different loan options outside of a line of credit. Line of credit's great for a lot of companies. What I do not like about a line of credit in construction is a line of credit's good when you're making a purchase order you're selling, trinkets, and I fund a purchase order with that money. I get all my things made. I go sell them at Walmart, and then I've collected the cash, and I can pay that loan back.
Right.
What the thing that I never knew, if you take one thing away from this podcast.
So what makes a line of credit very different from a credit card?
Yes, that is it.
Yeah.
The difference of what I thought credit was versus what it actually was. For me, I've had credit cards, and on a credit card, you can run up 10 grand and keep it there for the next 40 years. They would be happy to collect interest on $10,000 for 40 years straight.
Yeah.
Not a good idea,
No.
but you can do that.
Right.
And that was my understanding. What I didn't know about a line of credit is that they call it due once a year. I'd never heard that before. I never knew that.
Or it may not be once a year, but there are terms.
There are terms where it has to
it-
be called due. And what being called due means is we need your account to go back to zero, and then you can borrow the money again. But we need to see the rotation of the money coming back in 100%. I was never told that. I would never understood that. I'm sure it was in the paperwork somewhere, but I didn't read it. And so we got to the end of the first year, and they didn't do anything. They didn't ask for it to be called due. I had no clue.
Yeah.
We got to the end of the second year. We got to the end of the third year, and they called and said, hey, you guys aren't turning this money over. And I was like, well, yeah, we're funding our growth, right? Like I'm using that money on these jobs so I can start other jobs. And they said, well, I need all of that money back, and we got to go down to zero for you to keep this line of credit. I was like, well, good luck, because I'd have to fire my employees and stop doing work to collect all that money, like I said in the beginning.
Right.
I thought it was a credit card. I'm fine paying the fees because I'm making so much money off of this loan.
Right.
So let's just keep that all open, and y'all make your money off me.
Right.
And they said, that's not how it works, Clark. Sorry, that's not the way we do it. So if number one piece of advice with the line of credit, understand it's coming due.
Right.
And if you're using it for cash flow to take on more jobs, that means at some point you need that cash back, and you've got to stop taking on jobs.
Right.
And that's next to impossible when you're growing a foundation of a company and hiring people, and you say, I got to shut down 10 jobs for the next month so I can return this money.
Right.
I got to fire my project manager because now he has nothing to do. And I'm, so that would honestly, the biggest regret out of that, and the biggest piece of advice that I have is, you have to know the terms. You have to know when it's going to be due back. You have to know what type of loan you're getting.
Yeah.
Like I'm not going to list different types of loans, but there are plenty of loans that are more like a credit card where you can keep it open forever. And I would have probably liked to explore those options prior to the line of credit in hindsight.
Well, and there are a couple things about a line of credit that a lot of people don't know.
Yeah.
The bank has a lot of discretion of what they can do, and they don't have to tell you about it.
Yep.
The terms of a line of credit is that at any given point, with reason or no reason, and notification or no notification, they can call the note due.
Yep.
They can say, we want all our money on this that you owe us today. For absolutely no reason, and they don't have to tell you about it until the day they call it due.
Yep.
And so if the bank were to get into its own financial trouble, has nothing to do with you, they could come back and say, hey, you owe us this money.
Yep.
Right? And there's nothing you can do about it. It's a line of credit.
Yep.
The other thing is that one of the things that the bank has in their pocket is I'm forgetting the term of it. It's called right to offset.
Yep.
And a right to offset is the bank's ability to say, if I call this due and you don't have the money, we can, without notice, take every cent you've got in the checking account
Yep.
or the savings account or whatever.
Yep.
They don't have to tell you about it. They can just go and drain your accounts.
Yeah.
So that's just something to know,
Yeah.
which is why it's really important to say, to create up safeguards around a line of credit. Talking about kind of protecting yourself on a line of credit is the best way is if I pull money out, whatever that money that I pull out, I need to tie to money that I know is coming in.
Yep.
I'm going to finish this job. I've pulled $10,000 out to fund maybe
Main
my payroll.
Street.
It may be my payroll because I didn't have enough money at the time for the payroll, right? But I've got this job that when I get done with it, I'm going to have $100,000, right? 10,000 of that needs to be allocated to go back to this line of credit and pay it.
We've done that before where we've said, okay, we did an insurance job and they are a 60-day pay before we get paid back from this insurance company. Or it might have been a lend. I forget, but it was a 60-day pay, and we said, okay, this job's 100% done.
Yep.
We've got a $38,000 check coming on this date in 2 months, so we can pull out $38,000 from our line of credit and put it in our account to use for cash flow. But we told our office manager when that $38,000 check comes in, don't show it to us, deposit it, and put it back on the line of credit.
Yep.
Right, and so we're borrowing to get cash flow quicker, but we're not using that money to pay our bills and to just kind of disappear into our bank account.
Right.
And so it's looking at it and saying, okay, when I borrow money, we're gonna use our line of credit transactionally, not as a pot.
Yep.
So we're gonna pull $38,000 out, not 37, not 40. I'm gonna pull 38 out because I'm gonna receive that check early.
Yep.
Holding 38,000 for 2 months is gonna cost me a couple $100, but that's well worth it to start these next 3 jobs.
That's right.
And so tying it to a transaction like that is the number one way that you can protect yourself.
One of the things that I really love about what you just said that just kind of squeaked by in that statement, but you told the office manager, when we get this check, don't show it to me.
Yep.
Just put it over there. And I think line of credits can be really dangerous for entrepreneurs.
Yep.
Because the cost of the money monthly, the interest that you're paying on it is little to none, right? It's not a lot. It does cost you, but it's not a ton of money. So you pull out $10,000 to fund this job, and you say, when that job is done, I'm going to take that $10,000, I'm going to put it back on here. The job is done, and there's this new opportunity.
Yeah.
There's this new thing. There's this, you know what? It only costs me $100 a month.
Yep.
I'm going to take that money and I'm going to double down.
Yep.
And I'm going to do that again, and I'm going to roll it
If
into
I hired
this
one more guy, I can take on 3 more jobs.
Yeah, and then you take on that next opportunity. You go to that next thing. You've got a $10,000 balance, and then in that next thing, like you said before, the random things happen. Right? The truck breaks down. The flooring is majorly screwed up, and I've got to fund the cost of that. And now I've doubled down. I haven't paid down my $10,000. Now I'm at $15,000. Now I'm at $20,000 in my line of credit, and it creeps like that. And so that's a place that what was really helpful. You are something that I would call a serial entrepreneur. When you see opportunity, you're going after it, right? But you had the protection of, I have an office manager who is managing the finances, and I have let that office manager know when this comes in, it is allocated towards this, and handle it. Don't even show it to me, because I know I'll see that money and go, I could make more money off that money. Let me just roll with it, right? So it's just, again, I think there's nothing wrong with using the bank and what's available at a bank to help fund collateral and grow your business.
Unless you're Dave Ramsey.
Unless you're Dave Ramsey, no doubt. But it's going in eyes open.
Yeah.
It's going in eyes open and understanding that you need to safeguard yourself and understand how they function. That if you know that in 12 months there's a possibility they could call whatever your balance is due, you need to be cautious, be aware of that, know that date, know when it's coming up.
I would say this. A lot of guys listening will say, yeah, but I can't go into a bank and get $100,000 line of credit. I can't go get $500,000 line of credit. I don't.
We couldn't either.
My company's been open for 1 year, so they're not even going to look at me until after 2.5 years, or whatever the terms are. So a lot of guys will say that, or say, I don't have like a ton of work coming on. I don't have the ability to do that. I get that. if you don't have the ability to be transactional with a line of credit,
Right.
to where you say, okay, I'm $38,000 from the line of credit because it's going to be paid back on this. If you don't have that ability,
The diligence to stick with that.
yes,
And not
if you're
vary.
saying, hey, it's the wintertime, most of my work comes May to August, and I make a ton of money then, but it's December and I need money,
Right.
and I'm gonna just put it into the pot because I just have to have more cash or I'm going out of business. My advice: don't get a line of credit.
Right.
Borrow more expensive money and say, okay, I'm going to borrow $40,000 to fund me through May.
Right.
And that $40,000 I'm going to have to pay back at $2,500 a month for the next X amount of months.
Right.
Can I afford $2,500 a month for that many months?
Right.
That means one less hire possibly. That means I can't buy that new vehicle that I want. That means I can't upgrade my house when I'm, for the next 3 years till the money's paid back.
Right.
I would rather do it that way, to where it's planned how you're paying that money back. If it's going to money that's going to keep your company afloat,
Right.
and it might be more expensive money, but there's a game plan to pay it back,
Right.
To where $2,500 a month. But if I get a line of credit, I can just pay interest every month, and then I'll pay that money back. No, because you're not paying off your principal.
Yeah. Well, and the reason why traditional loan money is more expensive is, let's just call it $50,000. You get a $50,000 traditional loan every month. You have a payment that is interest on the total $40,000 plus some money going back to principal. So it's forcing you to pay principal back, which is the safeguard that helps you continue to be paying it back.
Yep.
But you're paying interest on the total $40,000. On a line of credit, $50,000.
Yeah.
On the line of credit, I have a maximum ability to spend $50,000. I have a credit line of $50,000, but I've only withdrawn 10.
Yeah.
I pay interest on the 10,000,
Yep.
but I only pay interest. So it's not forcing me to pay the principal, and I have to either have safeguards or just be really good and diligent at making sure that I pay those things back.
Yep.
Right. And so I think it's know yourself, know what you're good at. If you would be better safeguard to have more expensive money, go with that. It's okay. Plan for it, right? If you have the ability to be diligent with, I'm going to pay this back when I get that PO paid for, I'm going to pay it back on this thing, and I'm religious about it. That's great. Just know what you're getting into.
Yep. I think that's great. If you were looking at today and saying, okay, I'm going to figure out, I need some money, I need some cash, I'm going to figure out loans. What you should start with is
go to a pawn shop and get a loan from a pawn shop.
No, I mean it literally, you need to sit down and say, how will I pay the loan back? Not how much money can I get.
Right.
It's how little money can I get and how quickly can I pay it back. Because that will end your company.
Yes.
2 out of 3 construction companies do not make it to the 5th year of business. Census Bureau,
66%, right, is
64.5%, something like that, do not make it to their 5th year. And the majority of that is because finances didn't work out. You mismanaged the jobs. I didn't have the money. And the biggest way to mismanage your jobs or mismanage your finances is owing money that you can't pay back, right? You're taking on more debt and you owe more money than you can pay back. And so you've got to shut the doors.
Yep.
So if you're looking at money right now, you're trying to figure it out, either get a transactional way to borrow money to where I'm doing it, tying it to my transactions in my company to where I can pay it back, short-term loans. Or if you're doing long-term, I need money to stay afloat, then don't do it. Don't get a line of credit that's going to be called due in 12 months.
Right.
Don't do it because if you don't have the money now, how are you going to have the money in 12 months?
Right.
Right. And so that would be, I think, our advice to anyone is figure out what's the best loan for you and how and when it's going to get paid back. And if you can handle that, then you're mitigating your risk in that.
That's right.
Very good. Well, thank you guys so much for listening. If you have any other questions, if we are so totally wrong, if you're an accountant saying, why are you guys giving this advice?
There's your financial education from non-financial certified people.
Yeah. That's just the issues that we've dealt with, and our advice from that is where we're coming from. But we'd love to hear from you guys. If you have any other questions, anything else, go to our website. We love to talk with you. We've got a couple events coming up to where you can come. We do 2-day events where we do a deep dive, show you kind of behind the scenes how we built a company, every step of doing it, and then day 2 of that is let me show you how to implement it into your company. Let's look at your
2
company.
days to win.
2 days to win. So we'd love to see you guys there. Go to our website and go to the events, and we'd love to sign up and see you guys live and have the conversation.
Oh, yeah, man.
All right, y'all. Thanks for listening. Talk to you later.
See ya.